Welcome back, folks. This is U.S. Home Talk. We're live every Wednesday at noon on Facebook, YouTube, and wherever you find your podcasting. So all of the platforms. Welcome back. We appreciate everyone tuning in. Jason Walgrave here with Marcus Walgrave, Mortgage Mike with Illuminate Home Loans, and welcome to the new Showtime, Jerrad Havins with Credit Life. He is our financial freedom strategist. Jerrad, of course, is not... Folks, he is not new to real estate shows. He has been on Minnesota Home Talk with us for like 10 years. Overson and I have been doing radio for 85 years. So keep that in mind, folks, as well. So
we're really bringing this bit back. I don't think we need to do that. We're bringing it back.
That brought back some memories of being in the studio with you guys.
It brings me joy to talk about the 85 years and 50,000 shows that we've done. Here we are. We appreciate you guys tuning in. Best way to find us anytime during the week is our website, ushometalk.com. We have our real estate hotline number, which connects to any of us, all of our fantastic partners, which is 612-234-7585. During the show today, we're going to be answering any live questions that come in via Facebook or YouTube Live in the comment section. So please ask your questions there. We've got a couple pair of Timberwolves tickets to give away as well. So for the two best questions during the show. And again, you can text those questions to our text line, which is 612-234-7585, or simply in the comment section on our Facebook Live feed. You can ask the questions there as well. Super excited about the show. We have momentarily averted Snowmageddon 2023. It is apparently we're still expected to get 10 feet of snow yet in the next 48 hours. We've
only gotten through the first wave.
First wave, baby.
Of course, they canceled school today, so no school today. Although as I look outside, I think they probably could have had school today. But you guys got some more action down in Sioux Falls, Marcus, so you probably could have had school today.
No,
Marcus can't hear us. Marcus can't hear us. That's okay.
You did get a good snow.
You guys did?
Yep.
Yeah, I was going to say here in Lakeville, it dumped a little bit, but this afternoon is when it really starts. So I'm excited. I love snowstorms. Like, it's just so fun. Like, girls get so excited. I like it when you first go outside and like everything is really quiet because there's just so much snow coming down. I mean, it's just fun. Get out there and start playing with the kids and building snow forts. And I don't know, it's a good time.
I love it too. I love snowstorms. Went to mass this morning. As you can see, I got my ashes. Eliana and Joseph came with me, and Eliana was commenting on how she's like, "Oh, everything looks so beautiful, Dad. It's so pretty out right now." And so it is. I totally agree. I love snowstorms. Bring it on.
You know who really loves snowstorms? My wife. She really likes snowstorms, especially when they call school off and you got to do e-learning from home. And there's all four kids are at home talking in their different directions. I need this, I need that. Help me with this, help me with that. She wishes every day could be a snow day.
So our kids go to St. Mike's Catholic school, and they kind of follow the Prior Lake Savage district as far as when school is late or canceled or whatever. But what we don't have at St. Mike's is they don't have the e-learning set up. So I know that the e-learning during the snow days is very challenging for parents and for the kids, and so it's kind of a tough deal. But I think they do it so they don't have to add extra days on at the end of the year.
Yep.
Without a doubt.
Without a doubt. All right, guys, let's get rolling here. We've got Jerrad Havins with Credit Life. He is our financial freedom strategist. Jerrad has been in the industry for well over a decade. He has coached over 70,000 customers over the years, a national speaker, very talented, really, really knows his stuff. Jerrad's a good friend of mine, good friend of ours. And so, Jerrad, we really appreciate you coming on the show today. Today, we're going to be talking about credit and specifically how to build an excellent credit score. And what why do you want an excellent credit score? The better your credit is, and I'd say, Mike, would you say 760 is kind of that top tier?
Well, here's the thing, and we're going to talk about this on one of our shows coming up here. So Fannie and Freddie, they're the government-sponsored enterprises. So on conventional loans, Fannie and Freddie basically run the rules and they run the pricing on interest rates. They came out with a new loan level pricing grid. So that's going to go into effect on, I believe, April 1st. So they've gotten worse. So worse meaning that they've gotten worse for the consumer. So your adjustments on your interest rate that are going to be coming up here on April 1st are going to be greater. So the greater for the worse, if you have lower credit scores, if you're putting less down, there's all this whole matrix that I can share with you guys when we do that show to talk about those. But those are getting worse. And so the top tier bucket used to be 760. They actually added the top tier bucket, now went up to 780. So if you don't want to get hit with those additional adjustments on the new grid coming out on April 1st, you got to be at 780 to not get a hit with additional loan level pricing adjustment.
I mean that is a really high credit score. It's not very often we see clients that are above 780. Rarely do we see clients in the 800s. And there's there's so many factors that go into that. The history of your credit. You could have someone that's never been late ever in their entire life. They've got relatively low balances, but maybe how they or when they pay their bills isn't really monitored, or there's no strategy behind it. So we've had clients over the years where they've come in at 700, and we've taught them how to and when to pay their bills, and their credit scores have improved 40 to 60 points in a matter of 30 to 45 days. And so Jerrad today is going to really talk about how do you build an excellent credit score. Before the show began, I was thinking excellent credit score was 760. After April 1st of this year, it's going to be
780. 780. It's so funny around that, because what you're talking about, Jason and Mike, is so true. Like, typically when you have a client that has exceeded 780, a lot of times it's someone that's just older. They have more length of credit history. And that's not something that you can really manipulate, right? That truly is just time. So it's interesting that they're making that change, because a lot of people, if they don't have that extensive credit history and it's all positive, they're going to be shy of that 780 regardless of what they do. 760 is very achievable when you do everything correctly, right, over time. But that 780 plus mark, that's an interesting move that they made there. And I guess to me, it just shows, at least on my side, like anytime that we go through market changes like this and what we're facing, lenders typically pull back, they get more conservative. And to me, this is a move where they're saying, okay, they're just going to get a little bit more conservative, which I've always been an advocate of helping people and empowering people to get the best scores. Because as we know, the better your score, the better your credit, the better your rates, your terms, everything. But this just further solidifies it that people really need to take this serious, because I can only imagine the impact it's going to have on their loan rates if they're sub 780. Like if they're down in the mid 640s like it used to be, I can only imagine what that pricing looks like now with these changes after April 1st.
Absolutely. They're crunching down. The banks and the government are crunching down, right, Mike?
I wouldn't necessarily say it's the banks. It's the government, right? All these, so 70%, 80% of the conventional loans that are done in today's world end up in Fannie and Freddie's lap, right? There are some conventional loans that are non-QM that end up with, private investors and, hedge fund groups and things like that. But, a bulk of those conventional loans are landing in Fannie and Freddie's lap. And so they get to make the rules, right? Hey, if you want us to buy this loan from you, Mr. Lender, this is what it's going to take, and so then lenders have to conform in order to do that. And so it's not necessarily the banks that are making the call. It's just, it's Fannie and Freddie making the call, and it's just, working its way down all the way to, the borrower.
Yep.
Yeah, absolutely. So Jerrad, let's get started. How does somebody that, here's the thing with credit, right? It is confusing. It's complicated. And so how does somebody build an excellent credit score? Kind of what are the first steps? Where do they go?
Yeah, so check this out. I brought the whiteboard out, so hopefully people can see this. I don't know, Evan, can you do? Okay, that's perfect. So I figured, hey, if we're doing this on StreamYard, let's have fun with this, right? Let's, because we weren't able to do this on the studio in the radio office, so this is cool.
I love it.
So when you're thinking about, like, if you're someone out there, and we work with all different types of clients, clients that, have a really good income, all the way down to the single mom who has to really be tight with their budget. We help every single person. And the one thing that I found is that a lot of what I'm about to go over, this is just information that people don't readily have available. And on top of that, like, information on online world is very confusing. There's a ton of information about credit, but it's not delivered in a way that's easy to digest. And in addition, like, say, oh, that makes sense, so I just need to do this. So I wanted to talk about, like, some areas that anyone could do that's going to 100% put you in a much better position to start building up a strong credit profile. So one of the biggest things that someone is going to want to do is they're going to want to either have or establish 3 to 5 revolving accounts, which are basically credit cards. So if you're someone out there, and let's say you don't have that, you want to build up to that, because that 3 to 5 mark is a really sweet spot when it comes to the FICO algorithm. That if you have 3 to 5 active revolving accounts being managed correctly, which we're about to go into, that's going to put you in a better position to have higher score improvement. You can really start building out a well-rounded credit profile, basically. And so that's going to be goal number 1, is getting 3 to 5. Now, if you have more than 5, that's totally fine, but then you want to be very careful on how you manage your cards, like what we're about to talk about now, because it could put you in a position where you could end up having significant negative impact if you mismanage your cards. So, like, let's say we have the 3 to 5, right? The goal and how you want to manage these, which we've talked about a lot, and I just think it's important that people, understand this. To really, like, if you're looking, like, let's say we want to buy a home, right? And we want to apply for a mortgage. Well, the one thing that you want to make sure you do right away, and this is specific to the mortgage score. So for FICO, specific to applying for a mortgage, what you want to have is a 3% utilization percentage, okay? Utilization. And what that means is, on your credit report, it's showing, like, let's say you have a $1,000 limit. It's showing a balance of $30. That's it. $30. That's literally it. And so a lot of times when people hear that, they're thinking, wow, that's like nothing. Like, a lot of times people hear like 30%, right? That's a very popular thing. People say, oh, charge 30%, pay it off. To really maximize your FICO credit score when you want to apply for a mortgage, 3% is the best. And so that, I think if we could do these things, if someone could work towards that, they're going to put themselves in a great position to have a higher FICO credit score. I think that's one of the biggest things right there. This is an area that a lot of people can manage and actually do on their own, because, like we talked about before, you can't change, like, length of time, right? You can't change length of credit history. That's really just time. But this is an area that you can control. And if you do that, you'll be surprised at the positive impact. I mean, Mike, we talked about this the other day at one of our events, right, that you hosted. I mean, it's significant, the amount of boost that you can see. What have you seen with your clients when they do this strategy and paying down the balances to that?
Yep. So that same night there, I just worked with a gentleman that what he would do is he would charge everything on one credit card for the month, and then his statement would come out, and it would basically show that this credit card is maxed, and then he would go pay it off in full. The problem there is that now, month after month, when his statement comes out, it looks like he's got this card that's maxed out. It doesn't even show that he pays it off every single month. It looks like he's just carrying this max balance month to month to month, and that really hits your credit score.
Yep.
And it was his only card. He didn't have other cards to offset it, right? He didn't have the 3 to 5 cards. He only had one card that he used. And so I taught him the trick of, hey, you got to get your balance down. So when your statement comes out, you got to be at a 3% utilization or less, and your score will go up. Well, he did that, and the next month the score went up 81 points.
That's what I'm talking about.
30 days.
Yep.
That's what I'm talking about. That's amazing. You know what I mean? Like if you're someone watching this and you're like, hey, what do I got to do to boost my score? I mean, you just heard from Mike. Like that's one example of like someone following this instruction. 81 point improvement. It's huge. I mean,
So,
it really
Jerrad,
is.
Jerrad, this is such an important first step, right? And first, kind of first on your list on how to do it. I'm going to give you guys a perfect example. My daughter, Tanian, who you guys all know, she came to me shortly after her 19th birthday. It was her first year living in the dorms at college, and she said, "Dad, I don't think I want to live in the dorms anymore." And I said, "Totally get it. Appreciate, thanks for doing it. I think everyone's got to live in there at least a semester to experience." I said, "What do you want to do?" And she said, "Well, I think I'd like to, live in a house with some roommates and, close to campus." And she goes to the University of St. Thomas. I said, "It's a fantastic idea." And then she says, "Will you buy me a house?" And and I said, "No, I won't buy you a house, but I will teach you how to buy a house. I will show you how to get qualified." And so keep in mind, folks, she's 19 years old. She has no credit score. Like there isn't one because she's never had any activity at all. And so I helped her. She went out and she got 3 new credit cards. She was in college, so they're actually pretty easy to get when you're in college, in her own name. And then I added her to a couple of my accounts. And so she went from no credit score to a 720 credit score in 3 months. In 3 months, went over to Mike. Mike got her pre-approved for a mortgage with me as a co-signer because she doesn't have any income. But she got qualified based on her credit on this 3-month strategy that we put in place. Stuff that we learned from Jerrad and his team over at Credit Life. And so now fast forward, a year and a half, she has been utilizing, Jerrad, your strategy of 3%. So she's got, I think her 3 cards. One's a $1,500 limit. The other one's the same. And the other one might be, $1,000. So each month she goes out and she spends somewhere between 20 and $30 on each card every single month. So she showed me her credit score last month, 783. She's a 21-year-old that has a 783 credit score because she has implemented the strategies that Jerrad, you're talking about today and that you've taught so many people. Incredible.
Yeah, that's so cool. I mean, I'm so proud of her as well. I mean, she took what you said, she took action, she's following through. She's building up her life, her career, her wealth, through real estate. I mean, it's like that's what's so fun about this, like as you guys know, like I've never once got bored of what I do, like ever. It is so fun. Like the type of work and the impact that you have on people's lives, whether they're someone that's younger, someone that's gone through hardship in life. That's really common with a lot of clients that we end up assisting, is they kind of went through a hardship in their life, whether it be medical or job loss or things like that. And you're able to work with them and show them, what the solution is. And it gets them back on the right track. They're able to get into the home. They're able to pay off their debt. They're able to manage their debt correctly. And like, just everything opens up for them, right? And like the byproduct of that I really love is that their overall stress goes down as well. I mean, as we know, financial stress is one of the worst stresses you can have. So like when there's so many positive things that happen from this when someone takes control of their financial future. That's why I love it.
Jerrad, if we have the 3% utilization, the 3% utilization, if that's the ideal percent, that's where your credit score is being positively affected. Where are we getting at with like something that is a negative percent?
Yeah, so that's a great question, and that's one thing that's specific to mortgage. So one thing I will add, so 3% specific to mortgage. If you were, let's say, wanting to boost your score the most for like a credit card or auto loan, it's actually 9%. They're a little bit different because like that's something I wanted to bring up that's important is like a lot of people don't know that when you apply and FICO is being used, literally like 90% of all lenders use FICO when they're making a lending decision. But there are different models and different scorecards specific to what you're actually applying for. So if you go and apply for a mortgage and you apply for an auto loan, your scores are different. That's how it works. So now to answer your question, Marcus, is that, I always let my clients that if you start to exceed like 50% and above, that's when you're going to start seeing more of like a negative impact. If we're looking at lower than that, like, when you hit that 30% very common mark, it's still a positive, but what it comes down to is you're not really capitalizing on the potential. That to me is the difference. So it's like, instead of going like backwards, we're not capitalizing on the potential. And that's one thing too, the other night at the event that we had, it was so cool. I brought up to people that think of FICO, it's a risk assessment algorithm. So you're not necessarily always rewarded for doing what's right. I mean, proper management, you have to see that you're rewarded, right? Because if you didn't do that, your scores are lower. But the way the algorithm actually works is you are negatively impacted for doing what's wrong, basically, in their eyes. So it's you're always working against it in a way. Like it's not about building, even though it is. It's like you get points taken away easily. So when you make these adjustments, that's how you're able to work the algorithm.
So Jerrad, what if somebody, Mike's example in the beginning about how, hey, I just pay it off every month. And we understand how that negatively impacts you because it looks like you're always carrying a balance when it's reported. But what if somebody came and said, don't worry about it, Jerrad, I don't spend any money on my credit cards ever. So
Yeah.
I'm not at 3%. I'm at 0% always. Is that helpful?
Yeah, and that actually happens. I would say that happens in our area a lot. Minnesota is like naturally a little bit more conservative. And I'm fairly certain Minnesota, the past few years, ranks like the highest for overall average credit score in the nation.
Wow.
So, yeah. So, like, I just think there's a certain mindset in the Midwest where people are like that. They kind of view debt in a negative. And so, like, it's not uncommon to find someone that doesn't use credit cards. They're like, hey, I have them, but they're zero balance because I don't need them. I don't use them. I don't want credit. But the thing is, like, if you were, let's say you have some credit cards and they're at zero balance consistently, what happens is over time, if you don't have a reported balance or history, it almost becomes like inactive. And so you start to miss out on the point potential of those accounts that could really benefit you. So that's a big one. And in addition to that, zero, like, let's just say like you paid it down to zero and it, updates showing that, but you still had history. It's not necessarily going to cause a negative impact if it's a recent thing, but once again, you're missing out on potential points. Right. And so like, if you just do this pivot to 3%, especially if someone does zero, that's an easy pivot to make. And the positive impact could be great, especially for mortgage. Because as you guys know, in mortgage, every 20-point increment, soon to be up to 780, betters the interest rate and score. And it really is based off these 20 points. Well, what if you were at zero, you make this pivot to 3%, and you went from a 719 to like a 725, let's say. Well, now you've entered that next barrier of the 720 plus. You're in a different bracket now for better pricing. So like, that's why it's so important to know these things.
So
super helpful.
I was going to bring up one thing too with the zero cards, right? Let's say someone's got 3 credit cards out there and they just don't like to use them, right? They got them there because they know they need some credit cards in order to have a good credit score, but they just don't use them. So let's say you have a credit card, 3 of them, and you use one for your gas and stuff, just minimal stuff. You just log in line, you pay it right away. The other 2 cards just kind of sit idle. You just have them there. Well, if you let those cards go inactive for too long, a lot of times they'll get closed due to inactivity. So if you go from 3 credit cards open down to 1, that history still shows on your credit report. It still shows that you had those cards, but it's not an open and active account anymore. And your score will actually go down because of that. So, if you have credit cards that you just typically don't use, they're just open just so I can meet that 3 to 5 credit card, not requirement, but recommendation. Mm-hmm. You do have to make sure you use those every once in a while, once every 6 months or something, at least, to keep them active, because you could have those cards for 10 years. And as soon as they get closed due to inactivity, your score is going to go down because of it.
Yeah, that's a solid point. That's actually something we do a lot with our clients is like, let's say you have someone that does have multiple accounts open. Some of them, they've been maintaining a zero balance. to your point, yes, if they do that for too long, the credit card issuer could just say, hey, look, because they want to do business with you, right? It's a business, it's a business relationship. So if you're not using it, a lot of times they will just close it. Now we hurt our credit profile, we've negatively impacted our scores. But as well, what we'll do with our clients, let's say we have someone that does have multiple credit cards, and maybe they've even exceeded the 5. And so a lot of times what we'll do is we'll go through and we'll identify the ones that have more length of credit history associated to them. Because like when you, like, let's say, if they did have a balance on it, paying down a card that has more length of credit history tied to it improves scores faster. So like what we'll do is we'll identify the ones that have more history, and it's almost like, okay, here's the ones that we're now going to use moving forward as a tool to at that 3% piece. And then if we have any that exceed the 5, then what we'll do is we'll say, okay, for these ones, go ahead and just maintain a zero balance, but every quarter, just do one purchase, then pay it off. So that way it stays active in the eyes of that credit issuer. And if you make these pivots, like, it really can put you in a great position, not only to have like the best score, but you're also doing it in a way where, which I love, like when you maintain these lower balances, you're not paying significant interest on it either. You know what I mean? So like, that's another thing, is like people get into trouble. This is where like the financial wellness comes into play. It's very easy for people to like use credit cards as almost like an extension of income. It's just so easy to swipe it, especially if we're, buying's on emotion. So like you want something, oh, I need this deal, I need that. And you always kind of think, oh, well, I get paid on this day, I'll pay it down then. Something always ends up happening where you can't pay it down, or not as much as you thought, right? Then this card's creeping up, you're paying this high interest, and as Fed's raising interest rates, your credit card interest rates are going up. They're like 29%. Yeah. I mean, that adds up fast. You know what I mean? Like before you know it, your minimum payments are going up, your balance is going up. And that's where people start to get into financial trouble as well. So like, that's what's cool about this type of stuff, is like when someone's armed with this knowledge, they can start making these changes that really impacts their over financial behavior as well. So it really puts them in a good position all around.
Oh, it's good stuff, Jerrad. Love it.
So, yeah, I mean, I wanted to show something really quick, because I know a lot of times when we talk about this 3% piece, I just want to show something really fast, because I think it can be a little bit confusing when people, they're wondering, oh, well, then do I just, use it and pay it down to 3%? That's a common question I get from people. And that's not what we're saying. And so basically think about it like this, right? You have your statement that you get either in the mail or it's online PDF. And typically the way it is, you have this little section in the upper left that shows, your balance, right? Shows your minimum payment, due date right here. There's like a certain date. But typically what you'll find is right up in this area in your statement, it's going to show like the statement closing date or the billing cycle date. And so this is important, because this date here, this cutoff date, typically is a few weeks before your due date. So what happens is, let's say this is like a Capital One credit card, right? And they'll say like, oh, on the 15th of every month is the statement closing date, the end of that cycle date. Literally at that moment in time, they take your information, whatever your balance is, your minimum payment due, all that data is what's actually sent over to the credit bureaus. So literally you got, Equifax, Experian, TransUnion, right? This information on your statement here is what's sent to the bureaus. That's actually how it shows up in your credit report. It's not the payment itself. So a lot of times people think, oh, I got to pay it down to 3% or pay it off, by this date, and they'll report that way. No, if you didn't catch it by this date, it's already going to show. It's going to show exactly what's on this statement here. So what you want to do, you can do this two different ways. You can either do it how Tanian's doing it, where you literally only charge 3% of what the limit is throughout the course of a month, right? You could do Hulu, Netflix, gym, utility. Pick a bill that's recurring that you already pay, so you're not like generating more debt just to build credit. Like, you can be strategic, and then just put that on auto pay in full, and literally every single month it's going to work for you. 3%, 3%, 3%. Or let's say you're like a business owner, or you use your card for business purposes or for points or for miles, and maybe you get reimbursed, or whatever it might be. That's when this closing date here, this billing cycle date, is so important. Because then what you can do is 3 to 5 days before that date every month, pay it down to the 3%. So then when they draft this statement, you now control how it reports to the bureaus.
Yeah.
So you can do those two different things, and it's gonna give you all the power.
Yeah, that's huge, Jerrad. And in fact, I utilize that. I have 2 cards that I use every month, and then I have another 4 cards that one I have Sling set up on, one I have Netflix set up on, and then the other 2 I have these smaller reoccurring monthly bills that I have, and so those 4 cards every month have one small charge to them, but it keeps them open and active and open and active, and so it's a great strategy. I mean, my credit score typically sits around 800, 820, depending on the month, and so it's certainly you have, and we talk about this so much. You are responsible for your credit score, right? Nobody's going to look out for your credit score better than you are. And we talk about credit mistakes. I think it's 80% of all credit reports have some type of mistake on it. You've got to be your own advocate with your credit. You can implement these strategies to have the best credit score possible, which in turn leads you to having the most options when it comes to mortgages, loans, lines of credit, whatever you're looking for.
Yep, exactly. We call that the credit machine. When you put that on autopilot like that, it's the credit machine, dude. You just put it to work. It goes to work for you every single month.
Love it.
Keep it simple. I love it. Yeah.
So Jason, you touched on this a little bit, so we're talking how credit scores affect interest rates, right? Interest rate on mortgage loans, but credit affects a lot of different things, right? It's not only your interest rate, but if you're putting less than 20% down, it's going to affect what you're going to pay in mortgage insurance, also known as PMI. It would affect, a lot of employers pull credit when you're getting, when you're interviewing for a job and stuff. There's a bunch of different things, right? Now you guys are going to be impressed. I think you guys are all sitting down, so I think you're good. I actually drew a diagram here during our show to show all the things that credit affects, right? And so here's my diagram. It's very
the entire world. It's everything. I love it.
I'm very artistic, very good at that. But credit literally almost affects everything, right, in the country. I mean, it's credit is tied to almost everything, and so that's why it's so important to get tuned in with it.
Yep. And I found too that, I don't know if you guys have experienced this as well. It kind of like goes 2 ways. You have some people who have gone through an issue in their past, right, and they're almost embarrassed to bring it up, right, because it's like it's a point that's not, they don't like to talk about it, And then you have a lot of people out there that, there's like all this information out there, and like they're all about credit, and it can be very confusing. They end up getting misfed information. Like credit, like you're saying, it literally impacts everything, but it's like this weird talking point. It's either like in your face everywhere, Capital One, credit wise, all these Credit Karma, it's in your face nonstop. The reality is we have like people that don't fully understand it. And I think a lot of times they shy away from it. And the reality is, like, just think of us like a doctor, like that's what's so great about what we do is like when you start with a consultation, it's no pressure. We're just there to provide the solution, and as you can see here, when you do that, the opportunities that unveil themselves once you just get it fixed, it's immense. It impacts everything. Like you said, employer pull credit now, that's even increasing. I mean, everything we talked about. So it's like, I always like to bring that up because I feel that there's a lot of people that are hesitant to reach out because of that. But it's so worth it. I always have people tell me at the end of the call, like, man, that was really good. I wish I'd have done this years ago. That's a very common statement, and so it's that sense of relief that they have now that they understand that this can be fixed. I know the plan, I understand the plan, and I know what I'm going to get. They just feel better about it, so it's a really fun process.
Well, and Mike and I have seen, Marcus, you too, we've had clients over the years that credit is not tied to your net worth, right? And what I mean by that is we've had clients over the years that have come in, they have very high assets, they have a very high net worth, they pay everything in cash, or they have been for the last decade, and they don't have any credit, and so they'll come in and they've got a great income, they've got fantastic assets, they want to do a mortgage on a house that they can certainly more than afford, but they haven't utilized any credit for the last 5 or 10 years. And so they might be wealthy, they might have a high net worth, but unless you understand credit, the bank's still not going to give you a loan. and so it is. I think that's a misconception. People think that, that if you're wealthy, you have great credit. That's not the case. You still have to be strategic. You still have to understand how credit scores work. And so that when you do need to utilize bank financing and credit, you're able to do so.
Yep, without a doubt. And a lot of those cases too, it's like when someone is, I've heard this a lot from people. It's like, especially I'd say business owners, which I completely understand. We're all business owners. You get caught up in work, you get caught up in time, and you're going. And I've had a lot of clients tell me like, oh yeah, I could easily pay that. I typically just wait for them to call me when I'm late. Like dude, I'm serious. I've heard that so often where it's like, well, I could pay that any time, but I just forget, and eventually they call me, and then I just pay it in full on the phone. And I'm like, okay, well, that's good that you can afford these things, but look what's happening. Like, you want to go and apply for maybe this you want to buy this investment property or whatever it might be, right? Then all of a sudden they start realizing like, oh shoot, I should have done this a while ago. Like, but it's just so funny, like how everyone's a little bit different, but that's something that's actually happened multiple times. That comment people have made to me, it's like crazy. I'm like, okay.
I have personal credit cards and I have business credit cards. When we're talking about these 3 to 5 credit cards, is it specifically to the personal card, or do I get to reap the benefits of what I'm doing with my business credit card as well?
Fantastic question. So yeah, we actually do a ton. So at Credit Life, we have our personal credit and financial wellness division, and we actually have a sister company called Credit Biz, and that's our business division, business credit and business finance. And so, like, to answer your question, those strategies are specific to personal. It's very different for business. So like the one thing that you want to find out is you first want to find out if your business credit card actually reports to the business credit bureaus, because not all do. So you have to check that, number one. And then number two, the way business credit scoring works, the most popular is going to be Paydex score. And so literally your score is solely based on payments. You don't even have to worry about ratios. That's what's so great about business credit. And that's another thing that we do with business owners who don't want to play this game of management. Well, you don't need to if you go the route of business credit. But yeah, through business credit, you can get business credit cards under your business entity. A lot of times if you don't have business credit established yet, they will pull off your personal, typically just Experian, to make a lending decision. But then once you start building that up, all you have to do is use it, pay it on time, and it just builds on its own. And the score that you want to get to is 80 plus Paydex. That's your first benchmark, 80 plus. And that's going to put you in a bucket where now you're going to get better opportunities around business financing.
Yeah, that's a great question.
Yeah.
Do you only need one card for businesses, or do you still need like that 3 to 5?
Three is the initial benchmark. Well. Yep. So like what you want to do is you want to build up. So like, let's say you're someone and you have like a 720 plus, FICO score. What you want to do then is you can look at like, there's like Amex Business, there's like Capital One, Sparks, there's a ton of them. And then what you do is you can go and apply for these. And if you could get 3, that's the magic number. Because once you get 3 and they season for at least 90 days, that's when you'll begin to generate your Paydex score, and you can continue to build it up from there.
That's awesome.
Yep. We do this for clients all the time. It's, it's actually really fun too, because like if you're, a business owner, and what happens a ton with business owners is it's very easy to leverage personal credit for business purposes. Like it happens all the time because there's an opportunity, maybe it's marketing, maybe it's expansion, whatever it is, they end up leveraging their personal. And as we've just found out, if you over leverage your personal, scores go down. Very easy for scores to go down. Now all of a sudden you're completely hindered. You can't do things because you're kind of stuck. So like what you do is as you start to move that over into the business world, you create that separation from your personal credit. You can completely operate under your business entity. It becomes its own living, breathing thing. And it opens up so much. I mean, it opens up like, for a lot of clients, what we'll do is we get 0% business credit cards anywhere from 12 to 18 months. Nice. So literally you could get anywhere from like 10 to 50,000 limits based on your industry and your score. So now you can go and get 3. Now you have access to capital at 0% that you can leverage. Then as you're building up your business credit scores, then you can start looking at unsecured lines of credit. You can start looking at business term loans, commercial loans, SBA loans. I mean, literally it just opens up this whole world for you as a business owner if you just start, this path of like building up, the business credit itself.
I love it.
So it's an amazing thing. It's really fun to empower people, personally, but with their business as well. I mean, it just goes hand in hand. It's really cool.
I love it. You guys are doing great stuff.
Yeah, it's pretty fun.
So what else can folks do what else can folks do to achieve that excellent credit score?
Yeah, I was going to bring up one more piece to that is what you want to do. So we talked about the 3 to 5. Another thing that you want to do is you want to have like a well-rounded credit profile. So in addition, you want to make sure that you have at least 1 to 2 active installment accounts. So installment account could be, a student loan, could be an auto loan, could be a mortgage, right? Mortgage is actually the highest ranking, account that you can have there, which is awesome. So if you have that, that's wonderful. If you're working up to that, that's going to help you get into another bucket, which is great for the future. But you want to have at least 1 to 2, because if you don't, like let's say you just have a couple credit cards and that's it, you're really limiting your credit profile and you're missing out on a ton of score opportunity. So like when you have like more of a diversified credit profile of, 3 to 5 active revolving, 1 to 2 or more active installment accounts, and they're all being managed correctly, like we've been talking about, payments on time, low ratios. Now you're essentially showing, if you think about it, you're showing lenders that you have the ability to handle multiple accounts in a good way. Now they feel comfortable to lend you money. That's really what you're doing, So it's like when you manage it this way, you're not only putting yourself in a position to have better credit scores, higher credit scores, and a better credit profile, but you're really starting to build a profile where you're sought after by lenders. They want to do business with you because you're like a prime candidate for them.
When you say student loans, does that come into effect while they're still in college, or when you actually start paying those back?
Oh, that's a great question. So like essentially what happens like with student loans is every disbursement, right? So when they're going through school and they're getting disbursements, loan disbursements, those report as separate loans on their credit profile. And so essentially as soon as they receive that disbursement, they would start to report. While they're in school deferment, so they don't make payments on it, but it actually would still be on their credit report. And then once they get after school, it's a 6-month grace period. They go into repayment. And that's when you would see the updates to like, whatever the payment term is and all these different things. But during that, it will still report on the credit report itself and showing in-school deferment at $0 payment.
What about like your cell phone bill or, your Netflix bill? Are those considered installments or no?
They are not.
Okay.
Nope. Yeah, that's a great question. Those are not. And we heard about this the other day. It gets brought up a lot, so I'll bring it up on the show. It's the Experian Boost. People love them, the Experian Boost right now. So the issue is it's really, think about it like this. The bureaus, they make money on our data. They literally take it in, they sell it for a fee. And so like when Mike pulls a credit report right now, I mean, I think the average is like $66, right? For like a mortgage credit pull. I mean, it costs money.
Yeah, they're spendy for sure.
Yeah, and so that's how bureaus make their money. They're constantly taking in data and they sell it for a fee for a certain purpose. And so that's important to understand. But with utilities, they're not technically like, it's not technically like debt, it's a service. And so Experian Boost, essentially what they've done is they've provided a service. They say, hey, if you're looking to boost your scores, we'll sync up your utility bills and cell phone and things like that, put it on your credit report, and then as long as you had positive payment history, it'll boost your scores. Well, the issue is that doesn't work for a tri-bureau. It's only one bureau, right? So you're not benefiting all three. But the biggest issue is that a lot of the certain FICO algorithms don't necessarily equate that properly, like in how the coding is. So it could actually be like it show. I've even seen it on a credit report as if it was an unknown or collection. That's they're kind of have to keep up with the times. But Mike brought up something the other day that I was like, oh my goodness, that to me is everything. When you apply for a home, right? When you apply for a mortgage, outside of credit, a very big piece to underwriting is your debt to income ratio. Well, now you're essentially adding in more debt and monthly payments, and it's going to cause a negative impact to your DTI. So you qualify for less home by adding that on.
So don't boost.
So say no to Experian Boost.
Yeah.
Just say no.
Just say no.
Just say no. But I mean, yeah. So like, I can get crazy and long-winded, guys. I apologize, but there's just so many different things. Like this is why it's so easy for people to get confused. It's like, what in the world, like they see Experian Boost, they're thinking, heck yeah, it's going to boost my score. I love this. And they don't know the implications that it actually has, especially if you're looking to buy a home.
That's huge. I hadn't even thought about that, because there's a lot of ads out, right? They're advertising everywhere about the boost. And so no boost for you.
I would say
no to the boost.
Out of all the credit reports that have Experian Boost on there, I would say 9 out of those 10 people, I'm saying you gotta get rid of it. You gotta cancel that. You gotta cancel it now, because literally, think about it. Take 4 utility bills, right? Take your gas, take your electricity, take your cell phone, and take something else, right? How many dollars per month do you think you're spending on those types of utilities?
Like $1,000 easy.
Yeah.
Right. You got a big family, right? And you got a bigger house, you got heating bills, you got all this stuff going on, right? So let's say it's $1,000. Well, that $1,000 now shows up on your credit report that you have to make that $1,000 worth of monthly payments every single month. And underwriters are going to take that against your debt to income ratio.
Yep.
Yeah.
So, I mean, $1,000 a month, you're talking, I mean, that's going to be, I'm trying to work the numbers in my head. Like, how much buying power do you lose for $1,000 a month? You're losing probably $150,000 of buying power.
Yeah.
I know.
Yep. That's insane.
So you qualify for a $400,000 house today, but if you get rid of Experian Boost, now you qualify for a $550,000 house.
Yeah, that's a big deal, man.
Right?
Yep.
That's game changer if you're a buyer and you're going around with your realtor looking at $400,000 homes and they're close. Like, we just kind of need that one more bedroom or that one more garage stall. If you can go up $100,000, I mean, if you can go $50,000, you might be able to capture that must-have feature in a home. So, especially if if you go up to 150, you're talking about a completely different class of a home. So, pretty impressive.
Yep. And then, here's the other thing to think about too. Jimmy, call center Jimmy from Hope It Closes Mortgage. Does he have the knowledge and experience to identify that and coach you through something like that?
He does not.
Probably not. So again, it's the people you work with. I mean, the people we work with can save you money, can better your life. It's the amount of money you save on interest rate and PMI when you go to Jerrad and his company. You could be huge, could be gigantic. Yep. Same thing on the loan officer side of things. Same thing with real estate agents. The knowledge and the experience that comes with it is almost priceless.
Exactly. And I think that's the whole piece, is like when people start to obtain and have more knowledge, they can make informed decisions. That's ultimately a better outcome for their life. And another piece too, like more on the financial component as well. I mean, think about it like this. If you're someone and if you have someone that decides for whatever reason not to work on their credit, and maybe they get in to a mortgage at like a fair credit standing versus someone that goes in at a good credit standing, at the same price point, the difference in payment, could easily be, who knows, like $500 easy per month, right?
Yeah.
Well, if you think about that and that savings, that overall savings that you experience, not only in your payment, but the overall interest as well. And if you were to use those savings towards, like, let's say investment, start and invest in yourself into like a interest producing account, imagine over the course of 30 years, what that would mean for your financial security in the future. So this one change could literally equal hundreds of thousands of dollars if you do this correctly. You know what I mean? So like, that's another thing that we talk about with clients when we really start to break down the numbers. If they're thinking about, is this investment worth it? Yes, it is. It's like, it's less than 1% investment.
Yeah.
You know what I mean? And the outcome that you can experience is significant all around.
It's huge. I mean, just in your $500 example, $500 monthly savings example, that's $180,000 over 30 years. And that's assuming that you just put the money in your mattress, that you did not invest. And now you can take that money. Maybe you go buy an investment property. Now you have an income producing asset that the mortgage is being paid down. You're building a fair amount of wealth, through real estate, through having great credit, and being strategic and looking at all the different ways that you can, improve your financial future. So
yep,
it's confusing at times, but it's also exciting. It's exciting stuff.
So here's another point too, and let's bring Evan back on. Evan, what type of impacts do you have on insurance based on credit score?
I mean, it can be medium-sized, or it can be just absolutely colossal, depending on the region, the house, the individual, the family, all that stuff. But it's absolutely a rating factor that gets included because, ultimately speaking, your credit score is a huge dictating factor of how likely you are to actually file a claim rather than self-insure.
So, yeah, and it comes down to people just want you to pay them back, right? So if you're providing insurance, they just want you to pay for the insurance, right? Pay the premium to pay for that insurance. If people are giving you a loan, they just want to have the comfort and know that you're going to pay them back. And your credit score is really a measure of your ability and your habits of paying stuff back on time. So that's why it affects almost everything, right? Because I mean, it's it comes into play on all facets of life.
Yeah, and to expand on what Evan was talking about, and you, Mike, a lot of times when people hear that, well, why in the world does my credit impact my insurance? Like, that makes no sense. I have perfect driving history. And it's exactly what Evan said. It's been proven that people with a poor credit rating statistically file more claims. And on top of that, the dollar amount of those claims are higher. So what the insurance companies do is they pass that expense on to you. So if you fall within that bucket, you're going to pay more. So like that's another thing is that's why that happens. It isn't so much obviously driving record and all these other things in insurance. There's a lot that goes into it, impacts the policy as well, but it's not always just that. That's why credit plays a role, is because for them, they need to alleviate risk, and they do it that way. It's one of the forms that they do it in.
Yeah, and some states have passed legislation to actually ban the practice. Washington State did that. So we are seeing some movement from regulators, but in the vast majority of the United States, credit is a pretty big rating factor.
Yep. Yeah, it's in auto, home, and life. Auto, home, and life insurance.
I'll tell you what, this has been a fantastic show. Jerrad, super excited to be having you on today. We're going to have you on every month. So it is, you just do a phenomenal job. You do such great work for your clients and customers, and giving people opportunities and options. Folks, we appreciate everyone for tuning in today. As always, we'll be live Wednesdays at noon. You can catch us anytime, wherever you find your podcast. And of course, our website, ushometalk.com. Our real estate hotline number, which you can connect with all of us and all of our great partners, is 612-234-7585. Jason Walgrave here with Marcus Walgrave, Mortgage Mike Overson, and Jerrad Havins with Credit Life. Folks, we appreciate you tuning in. We'll see you next week.
Thank you.